Income tax is going to be an important consideration in your retirement plan. Now, tax planning is important in every retirement plan, but if you've got a certain amount of financial assets, if you've got a certain amount of retirement assets and you're approaching retirement, then I can safely say that income tax will probably be one of your largest expenses in retirement. Smart tax planning means that you will pay less tax in retirement, which in turn means that you can spend more in retirement. And ideally in those go-go years, those early years of retirement, when that spending can be used to its fullest for travel, hobbies, and entertainment. There are many strategies to reduce tax in retirement. There are things like RRSP meltdowns, there's different decumulation orders or decumulation strategies, there's income splitting for couples, but when it comes to how much you pay in tax to the CRA, these tax credits are going to be very important in reducing the amount that you end up owing to the CRA every year. Now, my name is Owen. I'm an advice-only financial planner, a CFP, and I'm the founder of Advice. And in this video, we're going to highlight these three important retirement tax credits. We're going to highlight how they work, if there's any restrictions to these tax credits, if there's any criteria that you need to be aware of. We're also going to highlight how much they're worth. So how much can you anticipate in tax reduction thanks to these tax credits? And then we're going to show you how they might impact a real retirement plan. So how they might impact your retirement plan in the future. How much of a tax reduction can you expect? And what does that actually look like in a real retirement plan? The first tax credit that's extremely important when it comes to retirement planning is the basic personal amount. Now, everybody gets this tax credit. At the moment, it's worth $16,452. It's a large tax credit. This is also a non-refundable tax credit. At the 14% federal tax credit rate, that means that this tax credit will reduce the tax that you owe to the CRA by $2,303 at the moment. It's a very large tax reduction. So the basic personal amount will reduce the tax that you owe to the CRA by over $2,300 at the moment. Now, this is a non-refundable tax credit, as I said. So when you're in retirement, you want to make sure that you're using up these tax credits, that you have enough taxable income that you're not leaving part of this tax credit on the table. Now, the second tax credit that's quite important in retirement is the age amount tax credit. Now, this tax credit is only available over the age of 65. So you have to be 65 or older in the current tax year to be eligible for this tax credit. But it's worth quite a bit. It's worth $9,208 at the moment. And again, if we multiply by the federal tax credit rate of 14%, we get a tax reduction, so a reduction in the amount that you owe to the CRA of $1,289. Again, combine that with the previous tax credit, this is a huge tax reduction between the basic personal amount and the age amount tax credit. The only criteria is the age amount tax credit. You have to be 65 or older in the current tax year. Now, the third tax credit that's really important when it comes to retirement planning is the pension income tax credit. Now, there are some criteria around this tax credit. So under the age of 65, you need to have defined benefit pension income to qualify for this tax credit. There are some other types of income that qualify, but this is the main one. The defined benefit pension income will help you qualify for the pension income tax credit before the age of 65. If you don't have defined benefit pension income, then you have to be 65 or older in the current tax year, and you have to have some RRIF or LIF income. So at least $2,000 of RRIF and LIF income. And that's how much this pension income tax credit is worth. It's worth $2,000. And if we multiply by the federal tax credit rate, then that leads to a reduction in the amount that you owe the CRA, the tax reduction of $280. So not quite as big as the two previous tax credits, but still very much worthwhile if you're over the age of 65 and you have some RRIF or LIF income, or if you're under 65 and you have the defined benefit pension income. Now, the combination of these three tax credits can be quite substantial. So if we add up the basic personal amount, if we add up the pension income tax credit, and if we add up the age amount tax credit, we get a total of $27,000, almost $28,000 in tax credit every single year. It's quite substantial. For couples, it's even larger. If we multiply it by 2, we get $55,000 worth of tax credits every single year. That means that we can have up to $55,000 of taxable income and essentially pay no tax to the CRA thanks to the tax credit and the reduction in the amount that we owe. So you can have $55,000 of taxable income from pensions, CPP or OAS, RIF or LIF withdrawals, RRSP withdrawals, and you can essentially pay no tax to the CRA because of the tax reduction from the tax credit. So this is very powerful when it comes to retirement planning. You can have a lot of taxable income in retirement and still pay very little to no tax to the CRA. Let me show you what this looks like in an actual retirement plan. So here we've got Sarah. Sarah is retiring at age 60 this year. And what I want to show you is how these tax credits will reduce her tax in retirement. It's actually quite noticeable when we get to the income section here. So here we've got Sarah's spending. So we're spending $50,000 a year after tax. That's the goal until we get to age 75. Then it goes down in that slow go phase. We've got a lot of assets in registered accounts. We've got some in TFSA. We're drawing that down a little bit more aggressively until CPP and OAS begin, or until that no-go or slow-go phase starts later in retirement. And overall success rate, not bad at 62%, but probably needs a little bit of work. We do have a lot of home equity we could always fall back on. But the key thing here is that in early retirement, all the way until age 75, we're spending $50,000 a year after tax. But when I go to the income section here and we take a look at the income chart, what you'll notice is that at age 65, there's a fairly noticeable drop here in the total amount of withdrawals. In early retirement, we're just drawing from the registered accounts. We've chosen to delay CPP and OAS until age 70 in this case. But look at this, at age 64, withdrawing $59,000 from the registered accounts. And then at age 65, that drops to $57,000. The reason is that we got from a tax bill of $9,300 at age 64, and then because of the pension income tax credit, the age amount tax credit, we see a reduction in tax where now we're only paying $7,000 a year. Now there's actually two things going on here. So not only are we paying less tax because of the tax credits, but we also have to withdraw less from the registered accounts because we don't need to cover that tax payment, that $2,000 tax payment to the CRA. So this actually helps us reduce the withdrawals even more. You can see how noticeable it is. We can see the reduction. All of the income sources are the same. All of the spending goals are the same. But you can see here the effect of those tax credits when we go from age 64 to 65. This is why it's material to your retirement plan. This is why you want to make sure that these tax credits are included in your retirement plan, because it can reduce your withdrawals quite noticeably once you get to the point where you're eligible for these tax credits. Now, if you don't have a retirement plan like this, if you don't have a retirement plan that includes these tax credits, we would highly encourage you to get one started. You can use the advice platform, everything we just saw there. You can use the software, the AI strategies. We also have a community forum for support, questions, and discussion, as well as our bi-monthly webinars. So it's only $9 a month or $49 for the year. If you don't have a retirement plan yet, we would highly, highly encourage you to get one started. Now make sure you like and subscribe if you want to get more retirement planning tips like this. I hope you enjoyed the video. I hope you can see why these tax credits are important. If you need to, I hope you go investigate these 3 tax credits for yourself and make sure that they're reflected in your retirement plan, because they can lead to a significant reduction in the amount that you have to withdraw from your retirement accounts. Thanks for watching.